Hey guys, welcome back to the channel. So it's been a really long time since I made videos in this channel. So because I was making lots of different types of content, I wanted to organize all those things, and yeah, I also moved to a new place. So this is where I'll be doing videos after this. The last time I did a video was like 3 months back, and I wanted to do this video specifically. And moving forward, like there'll be more videos coming like this. The reason I wanted to do this video is this huge problem right now in Canada. And before I start the video, I am not a financial advisor or a legal advisor, and this video is only for entertainment purposes. So before you jump into any decisions, please consult with a financial advisor or a legal advisor and make your decisions, or do your own research before you make your decisions. And so let's get into this video. I wanted to talk about this whole income tax in Canada, because that's something that so many people complain about, and so many people complain about like how much they pay tax every year. This is something that I have done in the past years, and it has worked really well. So I wanted to show you guys how you can fix it. And obviously this will not be for everyone. It's not that you cannot do it, it's just that the way, the structure, how you are working right now might not uh, go along with whatever I'm gonna say. So that's gonna be this video. So let's get into it. The tax rates or the tax brackets in Canada are pretty high, and this is pretty like standard with like other countries like US or the UK, all these kind of like developed countries. The tax percentage is pretty high, and we do pay like lots of taxes. Just to see like an example, like for 2024, federal income tax rate is like at 15%, which is like the minimum, like the first bracket, and goes all the way up to 33% if your income is over like 250k. If this is the only thing we're going to pay, then it's fine. But we also have like provincial taxes. Let's say if most of the people are in Ontario, so if you take Ontario, it's like 5%, the minimum, and then goes all the way to 13%. So let's say if you're making like 100k, so it's gonna be like 5% for the first 51,000, and then it's gonna be 9% for the remaining amount. So your tax rate would be like 9 plus 5, 14 by 2, which is like somewhere around like 7.5% for the provincial. For the federal, it's gonna be again 15 for the 55, and then 20.5. So again, 35 by 2 is like 17.5 plus 7.5, so which is gonna come somewhere between like 20 to 23% of tax you pay if you have like 100k salary. I wanted to show you guys this income tax calculator. So we all know Wealthsimple. It's a company in Canada. It's an investment company. Because we just paid taxes for this year, it just got over. So I think everyone would have filed their 2023 taxes now. But the thing is, let's do it for 2023. So I'm gonna keep Ontario as the example for this. It has certain inputs on the left side here, such as employment income. So let's say you're a full-time employee. That's it. So you just work, get a paycheck every 2 weeks, and then they deduct all the taxes, your CPP, your EI, all that, and then they give you the remaining amount. The only way you can save, or you can get like a refund later, contributing to your RRSP or FHSA, really have like lots of options. So let's put 100k as the example for this whole thing. So let's say you're a full-time employee and your annual salary is 100k. So if we put 100k here, you can see on the right we have total tax 26,000. So that includes like 14k of federal, 7,000 of provincial, and your CPP and EI is like 4,700. So your after tax income, you're only going to get like 73k after everything, and your average tax rate is like 26%. That's what you pay. So for 2024, the maximum anyone can contribute to the RRSP is 31,000. So again, I think it's very subjective to how much you have contributed like in the previous years, or all that. Otherwise it will like carry forward to the next year. We put 10,000 here. We don't like pay taxes for anything that gets put into this accounts. So if we do that, we are saving like $3,000. So for 10,000 it's like $3,000 tax. So we're saving that. So we're not paying taxes for this 10,000. So you're only paying taxes for 90,000, not 100,000. Right? So it again comes back to 76,000, after tax income. But obviously anything you put into RRSP, you cannot use it till you get retired. So your money is basically locked. If you withdraw from your RRSP before you get retired, they're gonna like pretty much charge you like the actual income tax rate for the next year when you file your taxes. On top of that, they charge another 10% withholding tax. Again, RRSP is not for everyone, like around like the 60-65 age. That's when you want your money. Then yeah, it's up to you. It's very subjective. Like some people want it, some people it's not for them. This is like a very simple scenario. You put this and that's it. So you anyway pay like 23% tax. So this is for people who are like full-time employees. So to save taxes, the basic thing you need to do is to change the way you work. So which means instead of being an employee, if you have the chance to become self-employed, things will change. Like how? I will show you. You have your own business, like a small business, but it's a sole proprietorship. You just run your own business or you run your own store. Your store makes 100,000. So we put that into self-employment income. So it's gonna pretty much be the same. It's just gonna be a little bit more. The reason why that is the federal and provisional tax are pretty much the same, but you pay more in your CPP because Canada Pension Plan works in a way where the employee contributes 50% and the employer contributes 50%. But when it comes to self-employed, you are the employee and you are the employer. So you need to pay both the shares, so both the 50%. So you need to pay the CPP completely by yourself. Sole proprietors and people who are like self-employed, they pay more in CPP. You basically end up paying more than being an employee. You pay like 28% and you only get like 71,000 after taxes. But the good thing here is because you're self-employed, because you're running a business, you can write off certain expenses. You can cut out like 20 to 30% of your income towards like expenses. Let's say you do like 30%, so that is not taxable. So you basically deduct that and your net income would only be like 70,000, which is the amount which comes on your NOA, and then you only pay taxes for 70,000. You end up paying anyway 27%. It's still high. The amount you pay will go down like a lot. You would have paid like 28,000. Right now you only pay 19,000. So there is a advantage and disadvantage to this. So the advantage is obviously you don't get to pay taxes for the 30,000, but the disadvantage here is if you are planning to buy a house and if you're a self-employed person, the only form of income proof you have is your notice of assessment. On the notice of assessment, it's only going to show 70,000 even if you had made 100k, because you detected all those things, and banks do not consider the expenses and all those things as income because you detected that, and they only take whatever amount is on the net income. It's only going to show that you're making 70,000. In reality, you are actually making like 100,000. That's the problem self-employed people always have when they go for loans and mortgages. As I said before, this method is not for everyone. You have to decide like which is important to you. So this is like the second scenario, and anyone who's already in this stage, I will just tell them to do one thing. Coming from an actual employee, like a full-time employee, to this stage, being here, if you've already come here as like a self-employed person, it's better to move to the next step. Change your sole proprietorship and start your own corporation, because corporation has so many huge advantages when it comes to taxes. So corporation is basically a separate entity, and you need to create a corporation name, you need to register it, and you need to have a separate bank account for the company. Any like income you receive, you put that into the company's account, because corporate tax rates are basically 50% less than personal tax rates. So the average tax rate for employees are like 25%, but the corporate tax rate is 12.5%, which is basically half. But if your business is making like less than 500k a year, then your corporate tax rate is only like 12.5%. When it comes to corporation, you can take your own income in two ways. You can actually do an entire payroll for yourself and then take like a salary. The second thing is just transfer it from company's account to your account as dividends. So the dividend, again, each one has its own advantages and disadvantages. So if you are again like a person who wants to get a mortgage in the future, who wants to buy a house and all that, it's better to go to the salary route, so that you can show that even if it's your own company, you can show the bank that you are getting this much of income. And it's up to you how much income you need. If you want to save money on taxes, you go the dividend route. You just take out everything. Let's say your company makes 100k. So your company makes 100k and you keep that entire 100k in your company's account. Whatever money is in your company's account, the tax is going to be only 12.5%. The moment you transfer that to your personal account, so the personal tax rate will come into effect for that amount of money, whatever you transfer from your company account to your personal account. You need to be mindful. Let's say we do the same thing. Your company earns 100k and then you deduct 30,000 for like business expenses. So you don't need to pay taxes for that 30,000. So we still have remaining 70,000. Rent, groceries, and all that stuff. It's not like really related to business expenses, so you cannot deduct those things. So just those things, for those things, average takes like $3,000 or $4,000 for like any person or like a family of two. I'm just talking just for rent, groceries, and very personal things. So let's say it's $3,000, and for 12 months it's 36,000. Let's say you only transfer 36,000 from your company's account to your bank account, to your personal bank account. So we go there and we see like two different types of dividends here. So eligible dividends are when you invest into like on the stock market, like public companies like Apple, Microsoft, all that. Whatever dividends you get from them, those go into eligible. Your own company is like a private company and like a private corporation. Any dividends you take from that goes into ineligible dividends. So for that 36,000, the only tax you pay here is $900. It's very subjective. It's not for everyone. If you are going the dividend route, you don't really have to sign up for EI, or you don't really have to sign up for Canada pension plan. You don't really need to contribute to Canada pension plan. You just get more money right now, which you can invest like in other places, compared to with Canada pension plan. You get it when you're 60 years. So there are some people who prefer using the CPP. I thought it's totally like up to you whether you want to do this or not, but I just wanted to show you guys this whole method, how to like pay less taxes. So with this example, you only pay like 200 federal and 700 provincial tax. It's only $900 overall, and your average tax rate is only like 2.5%. It's not technically 2.5%, which gets taxed at 12.5. So 12.5 plus this 2.5 is just like, I don't know, 13%, somewhere around that, like the average tax rate for your 70,000, compared to if you were a self-employed person, you pay like almost 28% for the same 70,000. So it's a very simple change for self-employed people, especially if you're a sole proprietor. I would highly suggest you to go and create your own corporation and be mindful of how much you're transferring to your personal account. Only take whatever you need, whatever has to go from your personal account, whatever cannot be like business expense, only withdraw that or transfer that. That's almost like reducing 10% of taxes, and also we're reducing the 30,000 of expenses. We're paying like zero taxes, so it's like a really good way. And obviously, if you're a full-time employee, moving from there to a corporation is kind of a long step, because you won't really know whether you can do it with your employer or anything. But if you're already self-employed person with like a HST number and you're like a sole proprietorship, definitely consider creating a corporation. I was a full-time employee, and I moved to self-employed. I was a sole proprietor, and then I created my corporation. Experienced those benefits. Kind of took me around like almost 2 years, and I just wanted to show you guys this whole concept of creating a corporation, creating an own company, saving taxes. This is a really good method, but some people, they don't really want to go through all these work. They just get a paycheck, they get a T4, they file it, they just send it, and they're done. So it's up to the specific person whether they want to do it or not. Some people won't agree with this. Some people just want to have a paycheck and they're happy with that. Like, I'm not really saying that's wrong, but if you want to save on taxes, and if you feel you have the opportunity to become like an independent contractor, like a self-employed person, definitely consider. And if you ever want to use this calculator, I'll put the link in the description. But yeah, if it was useful, please subscribe to the channel. I'll make more videos about this, about all this and more videos like this. Go out, try this calculator for your amount of income for last year, and see how much you would have saved if you had a corporation. So that's pretty much it. I'll see you guys in another video. Till then, it's bye.